Hello, everyone. Today on the Final Bar, it's February 7th, a Tuesday. We're going to talk with Ari Wald of Oppenheimer. We'll talk about some of the charts that are helping him make sense of these markets as the S&P, the NASDAQ pushing higher through the course of the day. Ladies and gentlemen, this is the Final Bar. Hello, everyone. Welcome to this Tuesday edition of the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a rainy Redmond, Washington. Thanks for joining us every weekday after the close as we break down the activity in the markets using the best practices of technical analysis. The technical toolkit is designed to help us understand the markets by focusing on investor psychology. I would argue when you're looking at prices, you're looking at a reflection of what a bunch of investors, millions and millions of investors worldwide are thinking and feeling, and how they're acting on their emotions and how those emotional reactions manifest themselves in trends and breadth changes and all of those other tools that we try to analyze. There's a really interesting interview earlier today with Chairman Powell of the Federal Reserve and David Rosenberg talking about a lot of things the Fed was trying to do. Saw a lot of noise in the tape during that interview. At the end of the day, the S&P finishing stronger yet again. Instead of trading down through 4,100, sort of pushing right back above that level. And so we're holding support levels. We're breaking out, and then we're holding those support levels. That's bullish stuff, right? Has the makings of a bullish tape. We'll look at a lot of the particular charts that make up all the comments that I just made, see what conclusions we can draw together. Let's get right to our market recap. I do want to start with the poll that we have running, as always, on our live stream page at StockCharts.com. We have a poll also on our social media accounts, so make sure you follow us on Twitter, subscribe to our YouTube channel. You will get questions like this. You just don't want to sell the stock until it hits $80 because that would mean a 20% gain. Which behavioral bias are you demonstrating? 51% of you, I am proud of you, Final Bar Nation, correctly answered anchoring bias, which is 100% right. The idea that you anchor to a particular level and then your subsequent decisions are relative to that level is an important concept. And it happens a lot. It happens when you get people saying what targets they have for the S&P. If they ask you for your opinion, but you hear a different answer first, a lot of times it'll anchor you to a particular level, sort of priming your thinking. And usually what you want to do is get away from that, right? You want to look at the evidence with biasless, if that's a word, with a lack of bias, focusing on just the evidence, ignoring some of those anchors and just focusing on what the trends and what the analysis can tell you. Now, 28% of you went for a name that I totally made up called excessive gain bias. I'm sure that sounded convincing, but it's not one. Neither is herd behavior bias. I made that one up too. So I got 30% of you on those. Anchoring is definitely the one. Confirmation bias is an important one. While I didn't describe that with this question, it was really a meaningful, or it is certainly a meaningful and arguably the most common behavioral bias that we see. By the way, we have a bunch of cognitive biases listed out with explanations of what they are and how they impact your trading. For more info, go to our chart school portion of the website, start searching for things like anchoring or confirmation bias. Find some really good articles to help nudge your thinking in the right direction. Continuing our market recap here, as I mentioned, nice move higher. There's a lot of choppiness in the middle of the day. You can see yesterday's relatively low volatility day relative to today. Today, you had this noise during the Powell interview that I talked about. At the end of the day, the S&P netting out to a positive, trading just below 4,100. Buyers come in and push the market to a new high for the day going into the close. S&P finished around 4,164. That's up about 1.3% from Monday's close. NASDAQ Composite up 1.9%. Mid caps and small caps all up as well. Mega caps and large caps led the way higher, with the S&P outpacing the others. VIX moving back lower, right? So the VIX remains below 20. We sort of got up to 20 earlier in the day when we were chopping around, but by the end, the volatility coming in. And so you're finding this pattern with volatility coming down, the market moving higher. This is sort of that slow and steady uptrend, I think, in a lot of ways that we talked about. I remember with Katie Stockton a couple of weeks ago, particularly talked about what we've not seen on this rally off the October lows is more of a slow and steady accumulation. And the way you can kind of figure that that's happening is the market sort of makes higher highs and higher lows, but the volatility starts to go lower. And what that means is it's sort of a slow and steady accumulation pushing higher. That's what gets that natural inverse relationship between the S&P 500, or a major benchmark, and volatility, right? Because people don't tend to, slowly and calmly sell their shares when they start getting nervous. They panic and they dump everything. This causes spikes in volatility, which is why the VIX tends to go up when the market tends to go down. So volatility coming off today as the major averages all in the green. Interest rates moving higher as well. And one of the end measurements by this day, there's a lot of movement around on the 10-year and other interest rate. As Powell was talking, by the end of the day, though, rates moving to the upside with the 10-year yield around 367. Bond prices, of course, moving lower. And the dollar index down a little bit today, but not too bad relative to historical movements. Gold actually ended up being sort of flat for the day. It was moving higher at times, but at the end of the day, it was pretty much a zero and unchanged for the GLD. So we're down about 0.5%. Energy prices overall moving higher. Cryptocurrencies, in the end, all netting out to a nice positive gain. Our top 5 most liquid coins that we track on our dashboard were all in the green. Ether prices up about 3.3%, Bitcoin up 2%, and Bitcoin touched 23,300, pulling back a little bit, but sort of re-approaching that level from below. Let's take a look at a chart of the S&P 500. Just think about what today means relative to this sort of historical trend. I was watching a video by Larry McMillan, who's a longtime options strategist, literally wrote some of the key books, I think, on options analysis, particularly from a technical perspective. A lot of the tools and techniques that you might use if you trade options and you use charts. Larry McMillan's work probably was part of that in some way, because he did some foundational work on valuing options and really analyzing them from an investment perspective. And if you look at what's happened, one of the things he was talking about was that 4,100 level, right? We reached 4,100 from below in late November on the S&P 500. We pulled back, then a couple weeks later retested that level. So you have sort of this double top, right? This level of confirmed resistance. That is why this blue shaded area we've been talking about for quite some time has an upper boundary right at 4,100. That's the November and December intraday high. That is clearly a level where the market has traded up to, but been unable to completely follow through on. Look at what's happened here recently. And I'll actually move the little blue box over so you can see what I mean, right? Look at this level, right? We bounced up against 4,100 a number of times. Then back here, remember a couple of weeks ago, we're talking about the break above the 200-day moving average, the break above trend line resistance. We have this golden cross, which I rarely point out because it's not my favorite, trend following technique in the world, but certainly got a lot of noise when we had that golden cross, which is the 50-day crossing up through the 200-day moving average. What's more important to me is the fact that we broke above 4,100 last week. We've now pulled back to 4,100 on yesterday's session. Today, we're kind of bouncing off. So a very classic technique in technical analysis or a phenomenon in the markets is a breakout above resistance, a pullback and a retest of that breakout level, and then move to the upside. That's why we often talk about that breakout level as being a key point, because what happens a lot of times in bearish phases is you will break above resistance, but then you'll fail. And you actually don't have to look too far on this chart to see examples of that, right? Look in late March, where we broke above the February high, stalled out and came back down. Look in August when we broke above the June high, traded above it for about a week, and then quickly started to rotate lower. That's the question mark for this current market, is can we break above 4,100 and stay there? A day like today, where we're bouncing off support, yesterday's close, breaking back to the upside or pushing back. That's sort of that follow-through move that we always talk about as being so important. I think days like today sort of are giving you that follow-through move type of vibe and suggesting that the uptrend potentially has further to go. Looking at sectors here, pretty interesting, with energy at the top of the list, up over 3% today. Clearly the best performing sector out of the 11. Not too far behind, though, is technology, up 2.5%, followed by communication services. You have 2 of the 3 FANG sectors up in the top 3 today. Only 3 of the S&P sectors finished in the red. Consumer staples down 0.4%, utilities and real estate down as well. Consumer staples are an interesting one, because one of the measures we look at and we think about for offense over defense is the XLY consumer discretionary versus the XLP consumer staples. I'll bring up the chart that we usually look at to think about offense over defense, and it's going to be this one here. Here we go. I was going to say, I'll get there eventually. How many charts do I have here? This one. Here we go. Offense over defense, right? So this top portion is looking at the XLY over the XLP. So cap-weighted ETFs measuring offense, consumer discretionary, versus defense, consumer staples. Or to put another way, things you want over things you need, right? And when this ratio is going higher, investors and really reflecting the behavior of consumers more willing to spend on discretionary purchases, things you don't necessarily need, but you kind of want. Now, that's generally speaking what consumer discretionary represents, although there's other things like housing, of course, in there. And consumer staples, things that you pretty much need no matter what, right? Things like household goods and beverages and stuff like that. The equal weighted version at the bottom of this, I have found to be the most meaningful because it takes the overweight of things like Amazon and Tesla away. It minimizes their overweight and it focuses just on the companies overall, right? In general, are we rotating in or out of the offense or the defense? Look at how this ratio peaked in November of 2021 before the S&P peaked in January. Look at how the trend continued downwards into July, where it made its eventual low for now. Look at how from May of last year through really January of this year, we're range bound, right? Sort of sideways. So as the market was deteriorating, you weren't really getting any downside confirmation from this ratio. Now look at how the equal weighted ratio has broken out, suggesting that investors are rotating more into things you want over things you need, or again, offense over defense. Of all the charts that I could show you, when I try to find one that I think justifies what we're seeing right now in terms of a risk-on move in the new year, this is probably one of my favorite examples to show that, just to show how things have changed in the fourth quarter going into the beginning of this year. As long as that ratio continues higher, and it's now going higher on a cap-weighted basis as well as an equal-weighted basis, suggests that the market trend is pretty significantly strong here. Just a couple other names to finish off. A lot of semiconductors in the top leaders today. Skyworks in particular was an earnings name. They reported after the close yesterday, up another 12.5% today. Again, the move today is impressive, but what is not surprising about the move, the direction of the move, is the fact that the trend has been positive really since October and November, right? That's when you started to make higher lows. That's when the trend really started to revert higher. Now we're making new swing highs, and today's upswing on the earnings win yesterday is just the latest move to the upside. And it's not the only semiconductor name in that sort of a position. QRVO is another one, up about 6% today. This had pulled back over the last week, but again, just a nice pattern of higher highs and higher lows, which is pretty constructive. CINF is another name, different sector financials, big move to the upside. Now, it's challenging with these kind of names when you've had such a significant move. What would concern me about a chart like this is you're trading into resistance. What that means is you've had a level where this stock has reversed before. This big move to the upside is now taking us right to that level. That's why, as a technical analyst, we often look for what breakout, right? Which is a level of resistance where we don't just trade to resistance, but we trade through resistance. That's why stocks like Skyworks, not just trading up to a level, but breaking through those levels is so important. And that's arguably why the S&P getting and staying above 4,100 is so meaningful as well. Let's take a quick commercial break. We'll be back with Ari Wald from Oppenheimer. We'll see you in a minute. Hey, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. It's such a pleasure to put this show on for you, and we appreciate you joining us. A couple quick announcements before we bring on today's guest, Ari Wald from Oppenheimer. First off, we welcome your questions. We had a mailbag segment at the end of last week. We'll do another one here at the end of this week, again on Monday. All of those questions come from people like you, trying to use charts, trying to use technical analysis. Let us help you along in your journey. Our email is thefinalbar@stockcharts.com. We're on Twitter @FinalBarSCTV, and we have a YouTube channel. Put a comment below the video you're watching there, and we'll hope to answer your question live on the air on Friday's show. Go to StockChartsTV.com. That's our on-demand platform. We are so fortunate to have really knowledgeable, thoughtful guests like Ari Wald, like Katie Stockton, Larry Williams, so many more, coming through StockCharts TV and sharing their words of wisdom. All of those interviews are available for free at StockChartsTV.com. We're on your mobile device. Just search for StockCharts TV on demand. In terms of our upcoming schedule, first off, a huge thank you to Julius DeKempener, my StockCharts compatriot, who bravely hosted this show yesterday and also on Friday. He did a fantastic job sort of keeping you updated and sharing some of his own thoughts, which I thought were really good, especially yesterday. His discussion on sector rotation, I thought was really well done. We have Ari Wald from Oppenheimer here today. Tomorrow on Wednesday, the 8th, Joe Rabel of Rabel Stock Research. On Thursday, February 9th, Jesse Felder, founder of the Felder Report. Coming up next Tuesday, February 14th, Mish Schneider, Director of Education at Market Gauge. Let's continue on our show today with our guest, Ari Wald. Ari's the head of technical analysis at Oppenheimer, joining us from the New York area. Ari, great to see you. Happy New Year. Welcome back to the show.
Oh, thanks, Dave. Always a pleasure to be on. Thanks for continuing to invite me back. I really appreciate it.
It's great to chat with you, as always, Ari. Your first chart is really talking about, I think, some of the improvement in breadth, right? When you think about how the markets have evolved over the last 6 months, particularly off the October low, we're starting to see improvement in breadth indicators. Talk us through your first chart and what that means for you here.
Yeah, of course. And I think it speaks to that the rules have changed here. 2022, a year where strength should be sold. And we think 2023 is going to be a year where now weakness should be bought. And the reason why I say this, is because of this chart where we're seeing a reversal in the S&P 500 of last year's downtrend, and it's being supported by broadening internal breadth. And in that lower panel, I'm showing you the uptick in the number of 52-week highs on the New York Stock Exchange, the net number minus the lows. And what it's indicating is that there's been an expanding number of stocks that have been able to clear their August peak levels, their August resistance. The equal-weighted S&P has been able to do this as too. And how we see it, that provides an internal tailwind for the S&P 500 to clear its own August peak, over the coming weeks and months. So here we have a case where the soldiers are now starting to pull up the generals, and you're getting this nice broad-based move to the upside.
When you're looking at a chart of the S&P area, we had obviously we made the new low in September, October of last year, made that higher low in December. A lot of eyes at 4,100. That was the high in December. Now that we've broken through that, obviously the August peak around 4,300 is a natural place to look. When you're thinking about a trend that is persisting, new highs expanding, when you're thinking upside from here, how much further, right? Because at some point it starts to feel like we've had a pretty decent run. Do you have upside objectives that come to mind in your analysis?
Yeah, that's a great question. And of course, more important than the targets is to let your winners run. And so it's how you get to those levels. But we came into the year and we do targets once a year. And the reason why we want to be wrong only once a year, Dave. But in our outlook report, we did come out with 4,400 for the S&P 500. And we get to that number by looking back historically. What has been the average performance coming off a major market low? That we were kind of basing our assumption. October was a low point for the market, a bear market low. How did the S&P 500 do in the next 15 months to get us to the end of 23, especially out of a non-recessionary bear market? Well, of course, we didn't get that recession last year. And we found that the average performance, the market was up about 25%. That's how we got to 4,400. And more recently, in one of our reports, we even made the case that the S&P would first climb the wall of worry to 4,600, that we would overshoot first. That 4,600 being that those peak levels from the first quarter of 2022. And also, if you were to take the height of the base that we've been in, projected from the reversal point, also gets you to about that 4,600 mark.
Really interesting. That 4,400 level feels like it's getting closer every week here so far in the new year. We'll see when we can achieve it. Your second chart we were talking about before we went live, and I think it's a really interesting look at rotation and leadership. Talk us through this one if you could.
Yes, of course. It's our sector culprit indicator. What it does, it measures the rolling return of the worst performing S&P sector over the prior 12 months at any point in time. What's the worst sector bet you could have made? And we originally created it to show that, at a market top, not only does market breadth narrow, but it's typically concentrated weakness as well, that there's typically a culprit sector already down 20% over a year-over-year basis ahead of below average return. So you think about banks breaking down before the rest of the market in that 07 period. And last year's culprit was communication services. And what we're seeing is now the year-over-year performance begin to turn higher at a very rapid pace. And we look back, and what we found is that this is typically action seen coming off a major market low. We saw it in 2003, saw it in 2009, 2016, off the 2020 low as well, that even the laggards of the prior bear market cycle are rallying in this tape. It's indicative of the broadening of participation, the low momentum leadership, and just continues to corroborate, this reversal in trend that we're seeing.
It's such an interesting chart, and I love how you've highlighted on the chart where this has happened before in terms of the worst performing sector. All of a sudden, again, not that it's the best performing sector going forward, but it's actually starting to work. And it's lined up pretty well with some of those previous bottoming patterns, which is really intriguing to me, Ari. Your last chart here, number 3, is really thinking about sector leadership. Energy, of course, one of, maybe the story in the first half of 2022, now starting to look a little bit more vulnerable. What do you see when you're looking at the relative strength of some of these sectors?
Yeah, this is another way to slice and dice the rotations that we're seeing, where the prior laggards are becoming the leaders and the prior leaders are becoming the laggards. So, first, obviously, technology in the top panel, that was being one of the culprits of the decline and underperforming 22. Now seeing its relative performance, that's versus the S&P 500, begin to turn higher, moving back above the 200-day average, and that's coming at the expense of the energy sector, where it's seeing its prior outperformance begin to moderate and move below its 200-day average. Again, this is just continued corroboration of this new bull market theme that we're seeing. And for us, the key portfolio theme here, it's not about growth or value, but really about offense over defense. I heard you talking about that as well in your lead-in, which is really the sectors that we want to be exposed to going forward. Our top 3 sectors: industrials, financials, and technology.
I'd love to look at a couple charts with you, Ari, if we could. And when I'm looking at the chart of the XLE, I'm thinking of names like, ConocoPhillips has pulled back to its 200-day moving average. A lot of these obviously had incredible runs. They've pulled back in the short term. And, one of the general approaches that I know you and I have thought about is sort of a nice long-term trend, but then you pull back a little bit, sort of gives you a good opportunity to buy on the dips. Is this a buy on the dips opportunity for something like energy that has been just one of the better relative stories over the longer term, but now starting to show some weakness? Or would you rather be focusing on some of those beaten down areas like communication services, which have been so consistently underperforming until now?
Yes and no. It really depends on your time horizon. I think as it stands now, it's this continued move towards the laggard comm services technology is going to continue. Energy, my take is this: it's not going to be the same one-sided energy leadership as we've seen. It's not going to be the same one-sided growth leadership. I think there is a case to be made to own both. When I look at energy, I'm looking at those stocks that were able to clear the big long-term hurdles, the 2014 high, the 2018 high, and I'm glad you brought up ConocoPhillips, because that was a great example of one of those stocks that were able to do that. That's where we're seeing a structural change underway, where I think that should be on the list of stocks to buy on the pullback. With that said, it does appear that some respect's going to be needed and required for the little bit of a breakdown that the stocks had, and it probably needs a little bit more time to stabilize over the coming months.
You mentioned this sort of, mental shift, right? From last year, it was, sell strength, right? Because that was your opportunity to sort of get out before the next big issue for the markets. Now more of a buy on the weakness kind of mentality. When you're looking at a chart of the S&P 500, if the idea is to continue to buy on the dips, that tends to work until the one that doesn't, right? Sort of that one that starts to break down. So when you're looking at the S&P chart, like, what's the vulnerability? What would you look for that would tell you the bull case that seems so clear now is starting to get a little murkier? Is there a signal or a level that would tell you, okay, hold on, we need to be a little more risk off mentally here?
Yeah, no, always a great question. It's important to ahead of time answer the question, where am I wrong? And I think for the S&P 500, the support level I'm watching is right around 3950. It gives you a little bit of flexibility. If by the time you get below 3950, you've fallen back below the trend line, you've fallen back below the 200-day average, and then the reversal is pretty much derailed at that point. It does simply just puts the market back in its base, and at that point, it's going to be important that internal breadth doesn't rebroaden on the downside. But for me, from as far as a trading level, what's going to keep me grounded here, I think as long as the S&P is above 3950, that bullish reversal is intact.
So my last question, we only have about 30 seconds left, but I'd love to ask about gold if I could, if you don't mind. We've had an incredible run. I feel like we've gotten so comfortable with gold not working. All of a sudden, it starts to work right in the fourth quarter in a way that we've not seen in quite some time. Now gapping lower. This is the GLD that we're looking at. Do you think gold is another one of those opportunities where you would try to buy on the dips, or is there something that makes you nervous about this as maybe a traditional safe haven that you'd avoid in a bull market phase?
Yeah, I think it's too early to buy gold. I'd let this one play out a little bit more. We did like it coming into the year, thought it was an attractive trade. But I look at the dollar, which typically has this inverse relationship with commodity prices broadly, which is now appears to be finding the lower end of its range. It's, is when the dollar broke out last April on the DXY around that 100 level. Now we're seeing it come in and respect those breakout levels. Former resistance becomes support. And I think as the dollar stabilizes here, now all of a sudden you have a ceiling on those commodity prices. So it does appear gold has topped out here. I'm range bound on the dollar. If it rallies a little bit, I think there's going to be an opportunity to buy some of these commodities. But I think it's just that it's a range that should be traded, and I'd let it play out a little bit on the downside here first. LD.
Sounds like we still have to pay attention to the dollar. We're not done with the importance of that area of the market. Listen, Ari, it's great to see you. Awesome to have you on. Thanks for talking through some market perspective with us. We'll look forward to seeing you at the CMT conference in April in New York, and stay safe there, all right?
This is great, Dave. I'll talk to you soon. Take care. Bye now.
That's Ari Wald. Ari's the head of technical analysis at Oppenheimer, coming to us from the New York area. I mean, what a fantastic guy to work with and talk to. I've always enjoyed chatting with Ari over time, and I like his take about thinking about the markets, just thinking about the general movement of risk, particularly the focus on the improving breadth conditions. Right? We've talked about the improvement in breadth off the October lows. You see how that informs his analysis. Thinking about sector rotation, thinking about leadership and laggardship, offense over defense. It's based on the trends and it's based on the relative strength. We're at a situation where technology improving on a relative basis, energy not so much. Let's focus on the area of the markets where the charts are improving. Great take there, as always, from Ari Wald at Oppenheimer. We need to go right to the 3 and 3. 3 charts in 3 minutes that tell the story of this market environment. Here is chart number 1. I featured this chart last week on my YouTube channel. We shared it on the show as well. This is the McClellan oscillator, which is a breadth indicator created by Sherman and Merriam. McClellan really is an adaptation of advanced decline data. This is not yet updated for today's close, but I wanted to point out on Monday's close, the McClellan oscillator did go back below zero. What's interesting to me, you have the trend still going higher, but when the trend is higher, this is why I asked Ari about what's your exit strategy, right? What would you see that would tell you that things might be, sort of lightening up a little bit? Things like the McClellan oscillator going below zero might be one of those. The bullish percent index going above 70 and back below, which might be happening this week. Those are all things I would be looking for. So watch this indicator through the course of this week, especially with all this earnings, to see if it rotates higher. Chart number 2, which of these 3 is the best performer over the last 10 years? The S&P, the NASDAQ 100, or Union Pacific, a railroad? It may surprise you to know the answer is actually UNP, right? If you look back, and I'm actually looking at 20 years here, 20 years of data going back to 2003. Here's Union Pacific up 2,024%. Here's the S&P in red, up 622%. Here's the NASDAQ 100 in blue, up 1,385%. I was listening to a Motley Fool podcast. They talked about the strength in railroads over the long term, right? These industrial companies like railroads and others, don't write them off just because they're not the juice. They're not the sexy way of playing offense. These are stocks that have actually worked over the long term. Also a great reminder of looking at long-term return profiles and seeing what types of names and themes tend to work. Finally, semiconductors. I mentioned in the market update, things like QRVO and Skyworks actually having a pretty decent day today. That's not just the one-off thing. These are trends that have evolved recently. The higher low in the SMH in December, I think, was meaningful. As long as we remain above trendline support, this is a chart that is working and continues to work. Folks, that's a wrap for today. Special thank you to Ari Wald of Oppenheimer joining us from New York. All of our previous interviews can be found at StockChartsTV.com. For StockCharts in Redmond, Washington, I'm Dave Keller. Be well, be safe. We'll see you tomorrow.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.